Welcome everybody. We are having more than 250 registrations, participants out of 39 countries. We are having registrants from Africa, from all of Europe, from Middle East, from North and South America. To some of them, good morning. To some of them, good evening. Thank you very much for being with us. About 1.5 years ago, we have been confronted with an event that was basically new for everybody. This event was having some specifics. It was global. For the very first time, something has hit everybody and everywhere. It was instantaneous, and that's something that we have never felt before, how fast something can change life, habits, people, and obviously companies. One of the things that happened was that in one shot, entire countries came to a standstill. And together with the standstill, there was a full stop on work, on activity in basically all sectors. Some countries decided to slow down, some others to shut down. Everything basically went into full stop. Governments in most of the countries were very, very fast in standing up and install measures, parachutes, cushions, emergency actions in order to save, to support, and to help the economy. In these days, we are going to be faced with something that likely we didn't thought about 1 year ago. We are going to be faced with the financials of companies, financials that are going to take in consideration last year, 2020. Usually financials are issued and are built up on an activity period of 12 months. As a matter of fact, last year it was not a 12 months year. For some countries it was a 10 months year, for some other countries a 9 months year. So in reality, what really changed in the setup of financials was the working period by these companies. Buying and selling is having something in common. It's related to credit and it's even deeper related to creditworthiness. And this is basically the starting point why I'm telling you all of this. That was the base of this event. My name is Alfredo Spadaro. I'm chairing Swissdacs, Swissdacs Group. Our job at our company is to evaluate, to structure, and to basically work on risk. So basically, we are engineering financial risk. We are optimizing liquidity. We are optimizing supply chain finance. And our partners in doing this job are banks and our companies. Most of them in Europe, some of them in the States. 3 months ago, and this is a little bit the genesis of this event, we were beginning to think about what is going to happen with these financials when the moment is coming through that companies need to release and to present to banks, to insurances, the balance sheets. And these balance sheets are obviously heavily influenced by a reduction of time, and in most of the cases are just going to be different. We were not concerned that they were bad or if they were good. They're just going to be different. And obviously, the other thing that were coming immediately in our mind, how are we going to measure risk? Because basically risk is based in understanding how was the past and how could I measure or estimate how the future is going to be. These companies are going to present these balance sheets to their liquidity partners, banks and insurances. And so the question that was coming up to us is what would be the analysis method to measure a company on the past, where the past was completely different to the years before. And how do I'm getting into the position to access, to estimate how the future can be? The future is today, because obviously it means how can a company basically go ahead in 2021, 2022. The second thing that came up into our mind was Governments. The government's parachutes are going to be finished, are going to be lifted, are going to be slowed down. And are the governments going to do this slowdown and this lifting in a coordinated way? We have decided to promote this meeting in order to discuss all of this. And we have invited to this table representatives of corporates, of banks, and insurances. And we were also very, very lucky and happy to get representatives of two organizations, associations, that are summarizing in an important way banks and insurances. I have the pleasure to introduce to you, with around 170,000 employees, production sites in 17 countries, ArcelorMittal is the largest steel producers in the world, and we have with us from Luxembourg the head of credit and supply chain, Laurent Steiner. Laurent, thank you very much to be with us. 23 associate companies in automotive, building, construction, energy, metals, and many more fields. This is Atlas Holdings from Greenwich, Connecticut. We have the pleasure of having the operating partner, Peter Bacon, with us. Hello, Peter, and thanks for being with us. With 17 million customers, 2,000 business outlets, it's a leader in retail investment, but surely in corporate banking. From Vienna, Daniel Rath, the head of corporate at Raiffeisen Bank International. Hello, Daniel. Thanks for being with us. Present in 100 countries, providing insurance. Most of you are knowing Coface. We have the pleasure of having with us from Paris the head of financial institutions for Western Europe, Laurent Gourevich. Bonjour, Laurent.
Bonjour.
We have two secretary generals with us. We are very, very lucky. FCI is associating 400 banks and financial institutions in over 90 countries. It's basically the World Organization on Factoring. From Amsterdam, we have with us Peter Mulroy, Secretary General FCI. That, by the way, he is not an Amsterdam, but it was a little bit too complicated to explain where we are. Thank you very much, Peter, to be with us.
Thank you.
Providing payment risk protection by their associates, close to 85 insurance companies and export credit agencies, thinking that the associates are covering 13% of the world GDP with credit protection. Very big pleasure to have with us Vindo David from London. Hello, Vindo, and thanks for having us with you. We would like to start with one question that will be equal for everybody. The format is basically going to be this. The first question will be the same for everybody. Then we are going to be having a very, very fast turnaround of the event, where we are going to place selected questions that are going to be different from each one of you. So it will be very fast. We are going to try to stay inside the time frame. The first question for everybody, and maybe we are beginning with Laurent Steiner. He is representing a corporate, and corporates are basically driving the economy. The pandemic hopefully will be fast, fairly over. But what kind of economics, what kind of financial world, in your opinion, are we going to face? Laurent, the word to you.
Thank you, Alfredo. So good evening, good morning, and depending on where you are, everyone. I just want to correct a slight thing. You introduced me as head of credit and supply chain, and see that also written there. That I'm head of credit and trade finance for ArcelorMittal Europe, but that's a mere detail. So let me just start maybe with the obvious. Economic cycles is something that is very common. It's definitely not the first one, and certainly not the last one. And every company, every corporate are used to live with that and adjust to new realities. Pandemics are also not something which is new. 1 century ago, the Spanish flu impacted 500 million of the global population, which is 1/4 of the full world population at the time, and it killed between 20 or 40 to 40 million people. The figures are a bit disputed. 20 to 40 million around the globe, while we are now, unfortunately, already at slightly over 3 million for COVID. So it was 10 times basically what the COVID is. Nonetheless, the crisis that we are having nowadays is really unique and never seen in human history, in the fact that it is affecting our daily lives and our way of living as never before. And the current crisis is really affecting the way we are interacting with people, the way we are behaving, the way we are consuming, the way we are spending our monies and our days. So the current crisis is on a short term mostly a crisis on the service sectors, the restorations, this kind of housing, accommodations, hotels, tourism, etc. But it was certainly a long-term effect which will be impacting the rest of the economy and notably the industry, and to an extent which is difficult yet to really completely grasp. It will certainly have an impact on the needs for infrastructure, the needs for airports, the need for stadiums, the need for roads, for trains, the impact on our mode of transportations, and then the needs for cars, for planes, for ships, which is, as you would expect, all very demanding in terms of steel. So this will have an impact on also on our business as in many different businesses. It will have an impact also on the way big international groups notably organize their supply chain. We see that notably currently in the automotive industry, which is also still suffering disruption in their supply chain due to the global turmoil following the initial COVID crisis. And that might be also impacting globally on the long term the international division of labor, which has been growing over the last century or so. With an acceleration over the last 20 years. So to what extent will that be shortening supply chains, which have been more and more complex and internationalized over the last decades? That is still something that is need to be clarified. And once again, that will have an impact for everyone, for the banks, just like for the corporates, as it will have for ArcelorMittal. And we definitely take that into account, that if tomorrow the global need for cars will be drastically and reduced on the long term, that will have obviously an impact on our business model, because we are also the leader in the steel industry for the automotive sector notably. So this is something that will be impacting us all far beyond the current restriction on travel and on social gathering that we may be having. So this will be indeed something that will certainly be affecting us on the long term. That will be demanding from all of us that we come with more flexibility and reactivity to adjust our strategies. And it will be only one further element into other criteria, like the adjustments to the environmental challenge that we were already facing before the pandemic times. Voilà. That would be my introduction, Alfredo.
Laurent, thank you very much. Absolutely interesting, your view. Peter Bacon, Atlas is present not only in many geographies. The companies inside your group are active in 4 continents, but they are also very, very diversified, and we are ranging, as I said at the beginning, in most of the fields of service production, from software to automotive to steel, aluminum, and so on. What is your take? How was the pandemic, or how is the pandemic really touching world, and where are we going from now? Would be really nice to understand your view geographically and from the latitude of all your businesses.
Thank you, Alfredo. So let me begin by apologizing because before this webinar began, I was looking at the photos of the roundtable members, and I noticed that the photo of me is in fact not me. It's a much better looking individual, pretending to be me. So I apologize for how I look now on the web. Okay, so rather than prognosticate about what the future might hold post-pandemic, which I'm not really qualified to do, let me describe what we are seeing as we come out of the pandemic among our 23 portfolio companies, which, as Alfredo said, are both geographically and industrially diverse. They're mostly present in North America and Europe, but they're also present in Asia and to a limited extent in Africa. By and large, our companies are industrial businesses producing products rather than services, and many of them process commodities, metals, lumber, paper, etc., into semi-finished products, which our customers then transform into end products, which we all use every day, such as houses, cars, books, tinfoil, refrigerators, and thousands of other objects. What we've seen is that from Q4 2020 onwards, a strong recovery in demand from a broad array of our customers across nearly all of our products, to be honest with you. And this recovery has strengthened in the first 5 months of 2021. And as demand from our customers has increased, as Laurent has just alluded to, we've also seen a surge in commodity prices. For example, as Alfredo said, we have a company which processes aluminium in Spain. Its raw materials metal prices are up 60%, 60% from the middle of 2020. We have several companies which either buy or sell lumber-based products in the US. Lumber prices have quadrupled in the last 5 months. And many of our businesses import raw materials and products from Asia and from the EU to the United States, and they have seen container rates more than triple in recent months. So we're seeing a big surge in commodity prices. Normally, we're very wary of volatile commodity prices because we're having to pay higher prices for our raw materials, and we may or may not be able to pass them on. In fact, right now, we are mostly able to pass on these price increases to our customers. And in fact, in many cases, not only are we passing on increased commodity prices to our customers, we're able to charge more for our processing. So our customers and their end customers are paying more for the commodities and more for the processing which goes into them. We don't know how long this spike will last, but the expectation must be that it will feed through to consumers as inflation in the near term. And I think to a degree, this is still anticipated but not fully reflected in markets and people's expectations. Generally, we don't think the pandemic will impact medium to long term the demand for most of the products our companies make because they tend to be staples for everyday living. But we do own a couple of businesses which are exposed to construction of large commercial buildings, such as office blocks. We were obviously very concerned about these businesses in the early part of 2020 as people left offices and went to online working and in fact online communication, just as we're all doing today. This led to a sharp decline in order intake for new projects in 2020. But I have to say, in recent months, order intake has picked up and it is now quite strong. Developers seem willing to continue to bet on densely packed urban workforces, even if they expect near-term work practices to remain more flexible than pre-pandemic. The desire to improve infrastructure, particularly in the United States, will also help these construction companies as we go forward. With regard to the financial world, moving away from our industrial things, we continue to see strong risk appetite from both equity investors in our funds and from lenders to our businesses. Atlas raised its fourth private equity fund during the pandemic. It doubled the size of the third fund. It introduced many new investors, and all without a single in-person meeting, something that would have been considered a fantasy 18 months ago. The distortion that's been wreaked on asset values by central banks through inflating means that there will continue to be strong demand, we believe, for good risk-reward investments. This means good news for raising private equity funds and bad news for investing the proceeds, as M&A values are inflated just as metal prices are.
Peter, thanks a lot. It was, as I mentioned before, extremely interesting to see the latitude of the comments that you did, because obviously the latitude of the activities of Atlas is huge. Daniel Rath, head of corporates at Raiffeisen Bank International. Your take, what kind of economic and financial world are we going to face?
Yeah, hello everyone, and Mr. Spadaro for the intro. Greetings from the end colleagues on the panel as well as the audience. Before looking ahead on the future, probably let me also spend a few words about the past, because I think it's important to look back a little bit, as the colleagues already did a bit here. Exactly a year ago, we were all either overwhelmed by the pandemic, in the middle of a shutdown, a lockdown, and finding ourselves in an environment where I personally felt, well, the world is over. I think that for sure we saw a large economic activity. Some sectors like traveling and tourism very hard. And as we saw in our research, the overall European area was contradicting by around 7%. I think that was enormous. As harsh as this hit us, we see, and honestly, we are already in a strong recovery, as Peter was also pointing out a second ago, especially sectors like industrials and construction. I think it's not a question about material prices, it's more about access to material at the moment. And also workforce is going to be a topic in this respect. Nevertheless, all this is what I see critics expect on a strong governmental support throughout our region and globally, and also here in Europe. I think the ECB with their monetary policy is supporting a lot. Now, what we saw in 2020 is an incredible increase in speed in two topics that are, on the one hand, us as RBI kind of taking our time and our efforts into, as well as our clients. The one thing is the digitalization. It was mentioned already. We have not this event here, but our interaction with our clients was virtual, a thing that we haven't thought, and it went well. But we do business strongly changing. We have a strong increase of the usage of our client platform. It's called My Raiffeisen, where we offer services and products such as e-account opening, e-KYC, or even e-signature, which is booming these days instead of paperwork. What we are currently looking into heavily is increasing the products on this platform, making sure that the interaction with our client works properly, and especially looking into new technologies in this space, especially the API topic that we want to foster in order to stay in with our clients and make sure we have an action and interface with. Last but not least, digital topic. We will put in place pretty soon a digital basket, as we call it. We want to support with financing small scale-up companies in the digital activities. We saw a huge growth there. Whoever was mentioned before was at home and got food delivered knows what I'm talking about. I think this is something we want to invest into. Second topic that is really a topic that I think 1.5 years ago was kind of trendy, but is now a topic that we see daily, the topic of ESG. We, meanwhile, have a huge impact on the bank. So we ourselves as Raiffeisen want to be a leader in the ESG topic. We also have clear targets on our portfolio development, but this will also impact our clients, our corporate clients in the region. RBI, for those who have seen, was the European bank in arranging green bonds in our region in 2020. And we spent for our client meetings in talking about ESG financing options with our clients. In addition, what we as a more cumbersome exercise to come up is the regulatory framework. I think this is starting with banks now with regulatory topic that we need to to the authorities. But I will later have the chance to also show to you a little bit what the impact on corporates will be in this respect. So a lot of efforts, but also a lot of changes in the topic of ESG. So summing up, from my point of view, we see a strong recovery on the corporate side. We see a still subdued demand on the credit side, but that's increasing in our region, and that's making us happy for the future, let's say so. And then there is investment, especially in digital topics as well as ESG. That's how I would sum up also the future of the development.
Thanks a lot, Daniel. It's interesting. You have already brought up a point that will be one of the topics that we are going to discuss a little bit later on. That this is ESG criteria who will be mandatory in a few weeks and very likely are going to be a driving point for everybody. Laurent Gourevich in Paris, your take, economy, finance, and obviously from your point of view, insurance and risk. You are insuring the world. So how do you see it?
Well, thanks for that question. It's not an easy question for sure, and there is no simple answer to that. Well, the world we are living in already changed a lot. And as said by Daniel, look at this kind of event. A year ago, it would have been a headache for your IT team to set up this kind of event, and even more complex for the attendees to connect. Now we are living with Zoom, Skype, Teams, Cisco, whatever. So this is a key change for sure. A year ago, Tesla was looking for cash with its own shareholders. Europcar was buying a new company in the US. Today, Tesla is making money with carbon certificate and with Bitcoins, and Europcar is fighting to survive. You never heard about BYD or Cattle a year ago, but today, everyone knows that these are the leaders in the battery pack for car components or for the automotive sector. A year ago, or maybe you already heard about Atos, the French international leader in the digital workplace. Most of the growth of Atos is now led by all the decarbonization solution that they provide to their clients. So is that a big surprise? No, we can't say that it came as a real surprise. These changes were already in motion. But the virus or the pandemic situation came as a booster for these changes. And to me, there are three categories of changes accelerated by this pandemic situation. First, there is a need for partial relocalization of some economies, of some industries. Don't get me wrong, I'm not saying that we can live without this Chinese support, but we need, obviously, to rebalance a bit our commercial relationship between Asia and Europe and Americas. This is a need, and this pandemic situation really put in front of us this kind of unbalanced situation. Second, digital is everywhere. Your smartphone is as powerful as your laptop, and you can buy a car with your laptop, with your smartphone. So this is a change, and this is a change we are experiencing for a couple of years already. But today, you need your smartphone. It's become your key instrument for your daily life. And the third main category, obviously, there is a need for green. Before the pandemic situation, we had the COP21. We had some new regulation in the financial sphere, such as the taxonomy or the benchmark in 2020. So obviously, there is a need for green. There is a kind of wake-up call regarding what we are doing to our planet. So yeah, if I have to summarize that, I would say that first, digital again is everywhere. The new world will be digital and will be green. And we have to rebalance the global and the local. I'm not saying it will be easy, for sure not, but I don't think that we have a choice. So from a pure business perspective, this is what we have to keep in mind to really assess where are the risks and where are the trends. So this is to me.
Thanks, Laurent. It's going to be, for me, extremely interesting to hear the next two interventions from Peter Mulroy and Vinko David. You are leading two associations that are basically summarizing more than 400 banks, most of the export credit agencies and insurances. Peter, what's a little bit the thermometer in your associates? What kind of economy and financial world are we slowly stepping in? You read concern, you read positive. How can you summarize these feelings inside your organization?
Thank you, Freddie. Well, I guess the best place to start is to just state kind of how the industry did in the factoring and receivables finance space in 2020. FCI reported its preliminary figures in April for the year, and to be frank, it was the worst year ever recorded in FCI's history. We suffered a nearly 7% decline. That's 2 times greater than the decline experienced during the Great Recession in 2008, 2009. But that being said, we have seen in the first quarter through April an absolute rebound. I'm hearing this from members all over the world. I would say especially in Europe and the US. I'm hearing companies recording the largest increases in business volume in their history. So historical growth figures starting in February. I'm hearing new business is exploding, and that's not unusual as companies look for alternative sources of funding. I will say that I think Laurent and Peter, Danielle mentioned just in terms of the growth, well, a combination of the surge in business, but also the inflation that we're experiencing. That is always a positive indicator of volume because we're an invoice-based industry. So it translates directly into volume. I don't know what that actually looks like, but it's certainly an influencer. Yeah, I would say there has been this drag on the industry as it relates to the stimulus programs and let's say these government programs to support SMEs. That has had a somewhat negative effect on advances in volume, especially last year, but also felt a little bit in the first 4 months of 2021. But the feeling is, from what I'm hearing, is that most of these programs will go away in the second half of the year. And hence there'll be an even further, let's say, surge. So it bodes well in a sense in terms of certainly demand. Yeah, I would say the other issue that we're seeing, that I'm hearing, we did a survey in August last year, and we asked what was on the top of minds of executives within the receivables finance space throughout the world. I think it was 90% stated that they anticipated that there would be a significant increase in spend in technology in 2021, 2022. And we're seeing that. I'm hearing that from a lot of our partner members that are IT companies in FCI. I would say as well, like if you break it down, what are these areas of investments? One is certainly in the area of artificial intelligence to, in essence, protect against fraudulent activity and to manage dilution risk within the receivables base. Also for client onboarding, so the client onboarding experience, integration into accounting and SIP-like systems, and data mining to kind of support also to detect fraud in areas where they can kind of see from that data mining. The third, let's say, observation is fraud. We did see a significant spike in fraud in 2020, but it was regional. It was in Asia, and I think everyone is aware of the significant increase in fraud in the commodity sector in the first half of the year. I would say that there was very little effect on the receivables finance industry. In fact, I did hear from one of the largest banks in Asia that they had factoring programs in place with one of the largest Hin Leong bankruptcy in Singapore, and they were able to get out of all their exposure. Why? Because they were able to rely on the source of repayments coming from the client's customers. So that was a real great success story, considering how dire that bankruptcy and fraud was. You can't not talk about fraud or not talk about, let's say, the impact of the crisis and not mention Greensill, because of course it was in our space. It was in the factoring and receivables finance space, in reverse factoring, supply chain finance. There are a lot of really interesting and fascinating stories and lessons to glean from the case. And it kind of touched on so many areas: compliance, of course, just commercial risk, operations risk, legal documentation, the use of third-party risk mitigants, and operational risk. And there is going to be, let's say, at the end of the day, a kind of a real, let's say, learning lesson, and what could occur, basically, an increase in, let's say, overnight regulatory reaction, which is something that we do not advocate for, and we do not, let's say, support. We obviously want it to be very thought out and thought through. At the end of the day, the crisis wasn't systemic, but it did raise alarm bells, and it continues to raise alarm bells in terms of all that went wrong with this entity. Greensill was not a member of our organization, and we were, let's say, very concerned about, let's say, the evolution and developments.
It left the sign,
yes.
Surely. Vinko, till now we have heard quite a bit of positive outlook. And we have heard that the effects of what happened were, in most cases, even positive. In your association, there are two groups. There are ECAs, export credit agencies, and there are private insurers, commercial insurers. And obviously, they are feeling the risk maybe differently, and maybe they have also different reading. What's your take on economics and financials we are going to face? And eventually, do you see differentiations between the two groups that are inside your association?
Thanks, Freddie. Now, let me start by saying that forecasting is very difficult, especially where it concerns the future. Look at a year ago, April 2020, many insurers, both public and private insurers, were expecting a huge wave of insolvencies due to the pandemic, and they were preparing for it. But it didn't happen. And the main reason why it didn't happen was the massive support packages, stimulus packages by governments, especially in the developed world. So the wave of insolvencies did not happen. Insolvencies in some regions even went down, such as Europe, which is quite counterintuitive. And that was entirely thanks or due to these very sometimes lavish stimulus packages, which kept afloat also zombie companies. I will come back to that a bit later. So it didn't happen. Actually, as a matter of fact, 2020 was quite a good year for the credit insurance industry. Demand went up because risk awareness got up quite considerably due to the crisis. Claims did not go up as much as many expected. So it was a pretty good year, not in all regions, not in all sectors, I have to add, but overall it was a pretty good year. And as many of you have said before, 2021 looks good. The economy is rebounding. So it all seems to look good. But I'm a bit hesitant here. And why is that? Freddie, you started by saying that the pandemic will be over soon. I'm not entirely sure. If you look at the speed of vaccination in especially the developing world, then it will take years before there is a critical mass, a herd immunity vaccinated. That means that the virus will have a chance to develop new strains, new variants. So it might well be that the corona pandemic will become endemic, or the coronavirus, which may not be very bad. I mean, we've also got used to the flu changing its variants every year. But this is something we certainly need to look at. Let's also look at both the geopolitical developments and the corporate developments. If you look at geopolitics, then you can see that in China especially, there will be more emphasis on development of the domestic market due to the disruption of supply chains. So China will move more towards developing the domestic market, less emphasis on export and import. Also, some buyers that have long supply chains may want to reconsider them, not by much, but there will be a new balance between cost efficiency of supply chains and security of supply chains. The biggest concern at the moment for the industry is how governments will wind down these stimuli packages. If this is done in an abrupt way, it may cause a shock and disruption. But we are quite confident that governments will not wind these packages down in an abrupt way, but in a well-managed way, not all at the same time, but gradually phasing out. This will leave one problem, as I've started with, that's the zombie companies. Many insurers, due to the government reinsurance they received, had to continue the cover on these zombie companies, who will pay the price if the packages are withdrawn and the zombie companies will go bankrupt. I cannot see a likely scenario that private insurers who did not want to underwrite them in the first place have to bear the cost, but that is certainly one issue that these private insurers with government reinsurance that they got during this year will need to negotiate with these governments. Thank you.
Vinko, thanks. As a matter of fact, just as a brief comment from my side, in some countries, I heard a little bit from the insurance branch, the comment, well, yes, 2020 was a great year, very little insolvencies. As a matter of fact, in some countries, insolvencies has been dismissed. They were put on freeze with moratorias. On the other hand side, governments have supported the insurance industry with interventions, but nobody went bankrupt. So the big concern is now we are going to phase out on one side the interventions, but if they are also phasing out on the other side the moratorias, then all at once companies are really again able to go bankrupt. And this is introducing me to the question to Daniel. The picture that you have given us from a banking point of view was a fairly positive picture. In some markets, there is quite a bit of concern if in June, July, whatsoever, governments are going to drive back on one side moratorias on insolvencies, on the other side, they're going to slow down a little bit supporting measures. Any feeling that this could mean that the bad part of the pandemic is yet to come? And is there a differentiation on geography on this?
Yeah, probably I'm a little bit tuning in there what Vinko was. Let me probably start with industry. What you have seen all, and you're following the media there, the results of most of the European banks in 2020 were weak. Many banks even reported strong losses. We in RBI had a reduced income, but still a profit out of it. But the impact that we all expected, and Vinko was referring to, I think that was kind of there already in the balance sheets. If you look then into Q1 figures of major banks as well as us, you see a very strong recovery. We have reported on Friday a year-on-year increase, 20% on consolidated profit, but still on the back of a strongly reduced risk costs. And I think that's the key of the question, that I think nobody wants to look ahead and say this is how it's gonna happen. Let me look into our client base, and this is why I would divide it here and what I expect. On the large corporate side, we see simply that all of them made their homeworks. They reduced strongly on working capital. They reduced in investments. They also made sure that EBITDA margins are on top of everything, and refinancing. So I think that the positive trend that really we saw within the last month, where I'm tuning again in with Vinko on the small and medium prices. Right, we are measures in this respect. They are a lot depending on governmental measures, but back to your question, I think the fading out of those measures needs to be a small one, or not as quick as some think one, a slow one. But I believe there will be also stimulus packages needed in order to really make sure that there is no large wave of bankruptcy, because basically in the middle of Europe we haven't seen any larger bankruptcy within the last month. So I think for recovery there, we are cautious in the small and medium enterprise sector.
Thanks, Daniel. Let me ask Laurent Steiner a more technical question. Supply chain. We have seen disruptions in supply chain. How much, in your opinion, was the impact? How strong was the impact of what happened in last year on the supply chain? And what do you think is going to happen with supply chain? Is this becoming a much stronger argument in future, so that we take some lessons out of it? Your company is basing itself on supply chain. So what's your take on it?
Yeah, sure. I think we already began to discuss that point. How many participants already touched that point? I think notably Laurent. I fully agree with what Laurent Gourevich said on that, and I think I also said in my introductory call that the complexity of the supply chain shows its limits during this crisis, and it's still impacting nowadays with the notably for what concerns the semiconductors shortage coming from Asia. So many car makers are currently suffering that, and impact their production line. We as a company, ArcelorMittal, we have a much simpler supply chain than this very complex and very complicated company which are the car makers. Fortunately for us, we also have so our own issues with getting the iron ore that we need to make our steel. We have less problems than our Chinese counterpart, by the way, because that works the other way around. So currently, if the commodity prices, notably the metal prices, are skyrocketing, it is also linked to supply chain issues, because the Chinese mills are, because of difficulties between China and Australia, notably, which is one of the main supplier of iron ore. These political tensions impact the quantity of iron ore which is flown to China. Then the Chinese do not export, or have even a ban on exporting of steel, which is having an effect, a side effect on the rest of the economy. So this need for localization, for simplification, and for less interdependence of the economies will be certainly also one way to reduce the overall risk factor for the completion of complex products like electronics, like automotive, etc. And comes in addition to that, of course, also all these risk of shortage of credit from the supply chain, which fortunately for ArcelorMittal we do not have because we've got a strong balance sheet, but we have also many competitors which are a bit in a bit more complex situation, and we have also to deal with our own credit risk with our own customers. If that can be answering your question.
Sure, but you gave me a perfect opening to a question that I have for Peter Bacon. With all what we are hearing and what just Laurent said, is it a bear market or a bull market? Is this a good time for making acquisitions? It's a better time to make dismissions. What's a little bit from this point of view, your take? Good time for business and purchases or standing by and waiting to understand how things are developing?
So let me talk about how things have developed over the last 12 months because they've changed quite a lot. Our company focuses on buying distressed or operationally challenged businesses. So when COVID arrived in the first quarter of 2020, we thought it would give us opportunities to buy distressed companies, although at the time we didn't know whether they'd be actionable in a world that was in lockdown. In the end, the pandemic was good. We were able to make 3 significant acquisitions of companies in distress, 2 in bankruptcy, and one whose multinational parent was super motivated to sell because of COVID and the uncertainty that COVID brought. COVID didn't cause the problems of these companies. It did make them worse. But most importantly, in the early days of the pandemic, it definitely impacted the price at which they could be acquired. In other words, the onset of COVID both reduced buy-side competition and reduced the prices of the targets. Many funds and corporates were wary about making investments when uncertainty was at its peak. Perhaps because we deal in distress every day, we found this perhaps easier to do. More interesting, though, is in fact not that the pandemic gave buy-side opportunities, but how quickly that window closed. By the second half of 2020, the market once again switched to being a seller's market. We began by selling a couple of our companies, first of all, companies that had not been hurt by COVID, and then companies which were economically very sensitive. All these processes have gone well, and honestly, we've achieved prices which we would not have dreamed of a year ago. So I think the answer to your question is, there was a brief window which people could action or not action during COVID, where you might get good value in the long term, and now it's switched back in a market where there's inflated asset values, inflated commodity prices, to where you're better off probably being a seller than a buyer.
Thanks. Vinko, allow me to come back a second on the first question and your intervention you did. You have public ECAs, you have private insurers. Right now, the market of risk is still based quite a bit on ECAs and government measures. They're going to be phased out. One question will not only be if they're going to be phased out slowly, one question will also be if they're going to be phased out in a coordinated way between countries. Now, if I very honestly have to comment how the coordination went on some other issues, I may have some doubts that we will see a fantastically coordinated exit or slowdown of measures, also because these measures are out of the toolbox of economy, so likely different countries will use different approaches. But what's a little bit at the moment the feeling between your private component and your, public component into your associates? Are they having the same feelings or do they see the nearby future differently? Vinko, sound, microphone.
Private insurers and ECAs are quite aligned on how they see the future, but they take risks differently because they have different mandates. What you see is that private insurers are strong in trade credit insurance, so-called short-term credit up to 1 year, and ECAs are more prevalent in the medium and long-term business. Now, what you will see is that here the risk outlook changes. If you are in medium and long-term credit insurance, it's mainly capital goods, infrastructure works. Their risks are really different and also impacted a lot by the sovereign risk. And here there are some issues. Some countries have been heavily hit by the pandemic, or the pandemic made their dire situation even worse. And some countries have not been able to pay their debts. An example is Zambia. So these countries need support, and that support will be given, has already been given by the Paris Club and the G20, and that will lead to at least reschedulings and maybe also some debt cancellation, but not on current business. And the ECAs will pick that up. Now, if you look at short-term business, it really depends on the sector. Some sectors are thriving. Some others have said that before, for instance, part of the IT industry, and other sectors have been heavily hit. There's no divergence between ECAs and private insurers, what sectors are hit or how serious it is. But if you are involved in a particular sector and that sector is hit, you will take the flat. Lastly, a year ago, we all thought that insolvencies would hit in the second half of 2020. At the end of 2020, we all thought that insolvencies would hit in the second half of 2021. The outlook now is that the rise of insolvencies will be quite serious but manageable at the end of 2021 and in 2022, but that depends on the phasing out of these government measures.
Thanks. Laurent, we have done common battles together in trying to set up, Laurent Gourevich, in trying to set up the assumption of risk, combining insurance and banking, because basically the view that we have shared and that we are sharing is that banks and insurances are have one thing in common, and this is risk. And this is obviously the combination point to corporates. Would you think that the pandemic could give us an opportunity in impacting this issue in a very clean and fast way, where at the end, because everything comes down in reading and assuming risk, maybe the combination of risk between banks and insurance is going to be a little bit easier, a little bit faster?
Well, that's a good question. Before answering this question, maybe a short comment on Greensill, because as you may know, we run a review of the potential impact on Coface from Greensill. And the positive news is that there is no direct damages to Coface. We succeed to stay away from this kind of poor risk. But my main concern regarding Greensill is really regarding the misunderstanding of what did Greensill versus what is a supply chain finance product. And again, the potential misunderstanding may lead to potential wrong way in terms of accounting treatment of what is supply chain finance. And again, this is my concern. Regarding our support to supply chain finance, there is no issue. I mean, Coface is going to support the supply chain finance structure as we are already doing. Regarding your question about the transparency and alignment between banks and insurers, after 2008, banks and insurers were working hand in hand to build up a safe environment. But obviously, because of competition and of need for higher return, a decorrelation between cost of risk and price for risk happened. Because of the pandemic situation, there is a rebalancing between price of risk and cost of risk. And we are going back to our key clients, meaning the banks, and asking for more transparency, a more partnership approach regarding the risk that has been insured and that will be insured. So we need to keep the full alignment between banks and insurers and corporates to be sure of what we are doing so that we can ensure the transaction. There are capacities. In banks are full of cash, insurers are full of capacities. So we are here for the business for good, but we need to really understand what are the underlying products. And again, sharing information, sharing the same understanding of one transaction would be key to get our support. And this is true for insurers. This is true for banks as well, I guess.
So we will continue together our fight to get this moving and to get this.
For sure. You can trust me.
Peter, Mulroy, let me allow to come back a second. You have associates in every corner of the world. And by the way, many of them are present at this meeting. I spoke also before commenting to Vinko, one of the challenges will be how governments are going to drive back supporting measures. And Vinko said also something that is absolutely important. The pandemic is not finishing. This is something that likely will be here till somewhere next year, because it's a long way that everybody is going to get the means of getting out of this with vaccines and so on. In your customership, in your associationship, do you see really big differences in the views about this whole picture? You see more positives or more negatives out of specific geographies?
Thanks, Freddie. I could just say in terms of 2020, it was very disparate, meaning, for example, in Europe, the industry declined a little over 7%. The UK, not necessarily surprising, was the worst hit. But keep into consideration, everything we do, we report in euros. So there was also some foreign currency impact on the translation in a number of countries, not just the United Kingdom. There were winners and losers. I can't, for the sake of time, I won't go into it now, but Asia was really, for me, the surprise. It increased by a little over 1%. I did not expect that. After seeing the figures for the first half of the year out of Asia, both domestically and internationally, Middle East, Africa, pretty much, Africa was up about nearly 3%. That was also a shock, I have to say, after hearing the GDP figures out of South Africa, which is the largest market, it accounts for 80%, being down over 50%. In the second quarter. I was just expecting it to be much worse, but talking to the members, it was they were very conservative, but they were able to have a much stronger second half of the year. The hardest region hit was the Americas. It was down nearly 30%. Latin America was down 38%, and the U.S. market North America was down about 22%. And in a way, that wasn't that surprising, because I know Vinko talked a little bit about the credit environment, and the credit environment in the U.S., North America, was much worse than pretty much anywhere else, even though I think the number of bankruptcies was not flat, maybe just up a little, but the size of these bankruptcies were significant, especially in the retail space, which is obviously where receivable finance and factoring lives in. Supply chain finance grew rather nicely. And that doesn't surprise me, because the fact that these are large corporates that are, large retailers, and large retailers did quite well, especially in the diversified food space, for example. The last thing I'll just say, non-bank financial institutions did not do well. The banks generally survived and kind of got through, but we had a number of members that filed bankruptcy or defaults or went out of business. Those especially relying in heavy emphasis in diversified retail, in hospitality, tourism, for example. That's all.
Thanks. Vinko, allow me to come back a second on the issue of the fading out of government support. It's a little bit something that isn't my bag and that I can really get out. I have a little bit the feeling that the governments were very, very keen and strong and supportive, But at the same time, they basically pulled out the switch, saying nobody can go bust. Now, in my feeling, and maybe I'm really making this very simple, the feeling is governments are going to say we return back to normal, so you have to go back to normal. Sure, that's correct, but you will be able to go bankrupt again. That's the way. On the same side, supporting measures are going to fade out, as it's also normal. So all the extraordinary measures that have been done before could really, how to say, disappear. Isn't there a bit of concern, also what I said before, if this is not really done in an aligned and timely way, that there could be space for a huge disruption?
Yeah, that's right. That is correct. That's one of the major concerns. Actually, credit insurers are not overly pessimistic about the rebound. There is a strong rebound, as some of you have already said, but much depends on the winding down of these government support measures. There is a big difference between Europe and the US, as Peter Mulroy has already said, because so far the support in the US was mainly to households and not to companies, while in Europe the support was to companies and not to households. And that makes a big difference. Companies that should have gone bankrupt in a normal economic cycle have gone bankrupt in the US. In many European countries, they have not gone bankrupt. They are maybe in a sort of coma, but still alive. And there are two issues here. One is, once you remove these government support schemes, there will, of course, be an increase in insolvencies. And that's healthy, because badly run companies need to go bankrupt to make place for well-run companies.
You clean up, yes.
Yeah, but this needs to be done in a managed way. When you pull away the support for well-run companies in an abrupt way, it could even damage them. And that is what we should try to avoid. And that is what we try to convince governments about. Do it in a managed way. Do it sector by sector, maybe region by region, company by company maybe, or measure by measure. That is very important. Otherwise, indeed, there could be a new wave of insolvencies. We all expect a rise of insolvencies because that's normal. After a drop in insolvencies, while many companies should have gone bankrupt. But the rise should not be sudden and not be too large in order to avoid disruption.
I totally agree. Just one brief comment. It seems that some governments have discovered that vaccines are a geopolitical tool in whatsoever measure. Let's hope they are also not discovering that supporting measures to be pulled or to be maintained awake are also a geopolitical tool. Otherwise, we could be surprised in seeing some surprises. I go back to Laurent Gourevich then immediately, because obviously the ball comes to you. Expecting claims in all of this picture, being prepared, hopeful that at the end, how to say, the good sense will prevail?
Well, I have no crystal ball, obviously, but you're right. The loss ratio of Coface reached an historical low this quarter, less than 30%. It never happened before. So as said by Vinco, the results in the trade credit insurance sector were good, or were exceptionally good regarding the current situation. Now, if we are looking at the very next future, there are two opposite arguments. First, how quickly will be withdrawn the government support. In France, for example, Bruno Le Maire, the minister, said clearly, we will not withdraw our support suddenly. We will do it in a proper way so that we are not seeing a large wave of claims. That's the positive side of the coin. On the other side, the experience shows us that when there is a rebound, there is an increase in working capital. So there is a need for cash. There is a need for banking support. And there are insolvencies because companies are unable to get this kind of support and they can answer to the customer's needs. So they are going bankrupt. So there are two opposite arguments. And that is the main difficulty today, to really understand what would be the impact of these two situations and what would be the magnitude of this situation.
Peter Mulroy, most of your, I guess I read basically half of your associates are relying on credit insurance or basically on mitigation methods. How was and how is their feeling on this? In your opinion, how is this performing? How was this performing in the past? How do you foresee this to get performing now in the very near future? Because what we are hearing is many things can happen, positive, negative, standby. So uncertainty is not something that usually is an advantage in the evaluation of risk. What's the take of your associates?
Yeah. Well, I will say uncertainty is a great, in a sense, like Vinko was saying, a great motivator to enter into receivables finance transactions backed by insurance. Yeah, it's we're a symbiotic relationship between credit insurance and the receivable finance industry. It's extremely strong. It's extremely important, and I'm very bullish personally as it relates to the industry, both sides of the coin. And why? Because after every great recession, and you can go back as far as the Great Depression, we saw, I think it was something like a 15% compounded growth rate over the following 50 years. I think after 1934 or something, right after the banking crisis. Great Depression, the same thing. We saw this big hit in 2009, and then for 10 straight years we had nearly double-digit growth. So I expect the same thing, even though we had the worst year, but I'm expecting it to really rebound. As it relates to I am concerned maybe about to Vinko's point, what's going to happen if we do see this surge of bankruptcies in the end of 2021. Because we are reliant completely, not completely, but significantly reliant, especially relating to non-recourse transactions. But to Vinko's point, I mean, we didn't see the knee-jerk reaction in 2020. There was, I think, we did a survey. 20% of the members stated the members stated that they saw about a 20% impact in last year. So reductions in lines in general, but those were just in a sense artificial because those were unutilized anyway. And then coupled with the reduction in sales in 2020, so. Really, I didn't see a significant effect like I expected, quite frankly, like we saw in 08, 09. And then, of course, the effect of the credit insurance shields was a big help. But to everybody's point, what's going to happen when this support is pulled? So it's a little bit of a question mark. But again, I don't see any effect. The credit insurance industry from the factoring perspective and receivables perspective is strong and will continue to be strong.
Laurent, Steiner, you mentioned you have seen on the supply chain channels some effects, but then this was fairly obvious effects. Are you are you getting the feeling that on the supply chain side, from a credit point of view, there could be tough times ahead? You mentioned your situation inside your company is very good. On the other hand side, other companies in other geographies with different levels of support could face a different situation. Are you seeing tough times coming ahead on supply chain finance?
Yeah, I wish I would be completely sharing Peter's optimism on that, but I think there is quite a fair difference between current crisis and the usual. And one is being that this current crisis didn't have the natural cleanup that we used to have, and which makes also sometimes the future uncertain. Usually, indeed, when you've got a crisis, the weakest die, and then you come back with the strongest competitors, and then the demand surge. And what could be a strong headwind would be that what would be the attitude indeed of the notably our friends Laurent and his peers in the credit insurer, which are allowing all corporates to get these key elements of their working capital apart from the normal financial loans or the own equity. And we all know that own equity for many companies in Europe and in the world have been drastically reduced because of all the losses which have been suffered in 2020. So to what extent we would be able, ArcelorMittal as any other supplier, big supplier in the industrial network, how could we be ensuring that we will be getting sufficient unchanged suppliers credits if at one point credit insurer would be confronted to a surge of insolvencies with the death of these zombie companies, which will be having a kind of vicious circles in terms of capacity to continue to flow the economy with sufficient liquidity. Liquidity currently is really flowing because of this governmental support and all the rest. I think there are still big question marks going forward in the future, and as Vinko said, that would be depending notably on how the governments will be terminating the public support and how smoothly these expected surge of insolvencies will be flowing, and what would be the attitude, notably on those which will be supporting the suppliers' credit, which are the credit insurer. What would be their reaction? So currently, as the situation is under control and rather good, as Laurent said, so they are really beginning to step back and be a bit more smoother than they were in last year. They reacted also to this crisis quite differently to what they did in 2020 and 28. Sorry, yes, in 2008. Sorry, I got it. But there again, I think there are still some big question marks to be answered on how this crisis will be fully terminated before we could be going fully on full optimism.
Listening to all of you, there is one thing in common that I'm getting a feeling on that inflation will be an argument that maybe at the end of this year or maybe next year we're going to face. And this is something that in our previous discussions we didn't touch, because if really inflation is going to come up, how will this impact on the availability on liquidity? How this will impact on the debt rate of countries and companies? Peter Bacon, just briefly, you explained the logics and the situation on your acquisition strategies. Do you see any changes on the financial structures in supporting these acquisition strategies that are going to be the consequence of COVID, or this is going to be fairly the same also in the future or right now?
So I think the short answer is that it will not change how we evaluate investments or how we finance them, but COVID has reinforced certain disciplines for us. As I mentioned earlier, because we focus on buying businesses in distress and needing a turnaround, we very focused on giving them enough runway to make that turnaround. So our number one concern, we look at a company and when we look at the companies we already own, is employee safety. If people can't come to work safely, then we don't deserve to make a return on our investment. And in fact, the businesses cannot run. Now, clearly, COVID put extra stress on our normal EHS practices. And I think actually because we were already very focused on EHS, we were able to cope with infection control, disease monitoring, the added costs and disciplines to do with that, and keep our factories running through the crisis. So that reinforced something we were already doing. And our second biggest concern once you get past employee safety, candidly, is corporate safety, liquidity. We've always been very focused on this, and COVID made us even more focused on making certain that any investment, any company has sufficient liquidity to prosper and survive. Many of our businesses, as I've mentioned already, have a high degree of operating leverage. They're exposed to commodities, prices they can't control. So we tend to use only modest financial leverage on these companies, and then often only to help working capital financing. Again, COVID proved the benefit of these policies because we were not financially over leveraged. Our companies were able to live to fight another day, which is not always the case in private equity owned businesses. Because we buy companies in distress, our investment process is all about projecting a different and candidly a better future for these companies. We don't just extrapolate the present and assume that that will be the future. So again, the COVID experience in many ways suited our modus operandi because we're used to looking through a period of change rather than, projecting a continuity, which some other investors might do.
Thanks, and I will come back to this because, in my opinion, the way of how you are looking at companies and also looking ahead more than looking behind is really going to be one of the consequences of the pandemic. Daniel, you mentioned in your intervention ESG criteria. ESG is going to be mandatory in June. ESG is nothing new; it exists since years. Now it's a time that ESG needs to be applied. By the way, this good stuff, and it's coming right on the moment where we need some good stuff that is going to be used in the analysis. What's the state of the art on this modeling? And do you get the feeling that this will be really helpful, maybe even a little bit of a booster?
Yeah, I mean, for sure, it's a good stuff. Let me answer that quickly. The question I would raise back is: are we all prepared for that? And there we see a different picture. Let me divide the topic in three perspectives I see at the moment. First of all, on the investors and asset manager side, so we see a huge pressure of investors to invest into ESG, what is on corporate bonds and the like, and this fosters us to use more. I was mentioning before our capabilities on bond sector, but there's much more interest in that we see here, and still we need to produce some yield, which is difficult these days, at least the asset managers. I think that's the first perspective. The second perspective is a clear risk management point. I read it honestly that the European Banking Authority wants us to implement the topic into our rating models. That's a clear direction we have here. We will need to go out to our clients in much more detail to question on ESG topics, on their impact of the business model. Honestly, we will need to bother them more in this topic and also make sure that with us as a banking sector also will dividing or bringing the topic into the economy. Last but not least, and there I'm not so sure if as I said before, everybody is prepared. We as banks are now by January 2022 obliged to report on sustainability very heavily. What was put in place now a few weeks ago is the Corporate Sustainability Reporting Directive that is now going further. 49,000 companies in Europe in the EU by January 23. So I think there's not much time to work on this one. We're working heavily and are approached by our clients how we can also take the learning out of the banking sector into the corporate area. But I think that's something that will take a lot of efforts of the banking sector as well as the corporate sector going forward.
Thanks, and I'm happy that we absolutely share the same vision. This is good stuff to come, and quite likely it's coming at the exact right point. Vinko, rating has been and is, well, it's something that is ruled by regulatory measures, by ECAIS. It's something that is used as benchmarking in evaluating risk. Yes, in your associates, a little bit the feeling coming up that the issue on rating needs to be a little bit further developed, maybe not really applied in the way that today we are looking at it, maybe having a little bit of time and effort spent in foreseeing the future and a little bit less in reading the past. What's the feelings on rating as itself?
Yeah, when we talk rating, many people would think of rating agencies in the first place. But actually, most financial institutions, including credit insurers, have their own internal rating models. And why is that? You look at what the customer wants, the exporter or the financier financing export, and they want a credit limit immediately. And you can only do so if you have analyzed all risks in advance. So the rating models that many credit insurers use have typically three levels. One is the national or sovereign level, so the political and macroeconomic risk in a certain territory. The second level is the sector level, and the third level is the individual corporate. Typically, that's the build-up of ratings in a credit insurance industry. Now, what is important now that we have seen is that at that lower level on the corporate risk, you really need the most recent figures. An annual report 1 year old is nice, but not convincing. We have seen that during the pandemic and also actually during the global financial crisis in 2008, 2009, that you really need to have the most recent financials, even if they have not yet been published. Then the next level, that's the sector level, that has become more important. You've seen the impact of the corona pandemic on sectors. Some sectors have been heavily hit. Other sectors were thriving during the pandemic or are still thriving during the pandemic. It's very good to keep a keen eye on that. And then the national level, I'd say political risk is back, and that has been emphasized by the pandemic. The pandemic caused some countries to enter into financial distress at the sovereign level. So all three levels are important. I'm not sure that all, say, professional rating agencies always grasp the complexity of cases where, for instance, credit insurance is involved, for instance, in the Greensill case. But that's a completely different matter. So credit insurers rely rather on their own ratings than outside ratings.
Laurent, thanks, Vinko. Laurent Gourevich, is your company looking into getting changes done into the evaluation methods? And are these changes really only a consequence of COVID and are going again to be measured in, or is this something more on the basics of changing approach? Vinko, absolutely right what I said. You cannot rely on last year's. And then if last year numbers are coming in June, July of the year after, basically you are looking at the picture that was taken, 1 year ago, if not 1.5 years ago. In these times, it's completely useless where the world is changing in 3 months. So maybe looking not really strongly behind, a little bit more specific ahead. What's Coface's views on it?
Well, you're right. That's a key question. I mean, this is the art of underwriting. I mean, to assess what is the risk and based on what? Financial figures, but new kind of information as well. And this is what our risk underwriter did during 2020. Laurent Steiner is right. There is a need for trade credit insurance support. And thanks to our risk underwriter, we enter into the crisis with more than 500 billions of guarantees. At the end of 2020, we still had 500 billions of guarantees. Obviously, some sectors were hit by the crisis, some others were the winners of the crisis, and our risk underwriter was agile enough to move some limits from one sector to another. And this is exactly what we have to do in 2021. We need to get as much as possible fresh information, updated information, and to look at each chain in the link to better assess where are the risks. We were good at it in 2020, especially when we are looking at the automotive sector, for example. We were running a review of all the value chain of the automotive sector, from raw material to car dealers, for example. And thanks to that, we knew where we had to put a credit limit or not. Unfortunately, we were not that good enough because we were missing the shortage of the IT component, for example, like Laurent said. But we were quick to react, meaning that we were trying to assess what would be the impact on the full chain, and then reshape our global exposure on the automotive sector. And this is key for us. Regarding our current algorithm, we will not reshape all the algorithm we may have to put a rating on a company, but we have to fix some of the parameters. For example, in our current algorithm, the evolution of the turnover is highly weighted. So we have to reassess what is the weight of the turnover evolution in our model. Otherwise, obviously, the 2020 financial figures will have a huge impact on our rating. So this is something that we did already. We have to test this algorithm, but again, even the algorithm has to be balanced by the human view and the human expertise on the sector or on a company.
You need to vaccinate your algorithm.
That's a good
Peter, Mulroy, I will play the bad boy. Obviously, every bank needs to do their own rating assessment. On the other hand side, as Vinko rightwise said, there are three levels, and the credit or the rating analysis on countries is usually taken from rating agencies. Now, as I said, a little bit the bad boy. In your feelings or in the feelings of your associates, are rating agencies still going to be seen in the same way and weight as the beacon where the truth lay and where the beacon where we are heading to, or a little bit more of independent and adapted view shall be needed?
Thanks, Freddie. Well, that's a loaded question. We didn't see the same mistakes made during the 08-09 financial crisis in the subprime mortgage sector with relating to the rating agencies as we did in 2020, meaning it was a relatively clean year from that perspective. There were some outliers, as we've discussed. I don't see, truthfully, any, let's say, major impact in comparison to what we saw 10 years ago, from the standpoint of using external credit rating agencies to determine the risk, the quality of the risk-weighted assets for capital adequacy purposes. I'll say though that again, going back to this case that we keep bringing up, that it will, it could have some, let's say, scrutiny from the standpoint of how risk mitigants in general are viewed as it relates to large exposures like we had in this case. And that is something that I have great concern on. And I also have concern on, what we pride ourselves in our industry. And this gets back to Laurent's comment, which was a correct comment, Laurent Steiner, about, in general, his concerns about risk, and I don't disagree with you. But that is what the receivable finance industry does, and does extremely well. And so this is why I'm bullish, because we control risk, we mitigate risk, and we obviously use third party mitigants, but it's what we do. It's our expertise. So I don't expect a big, let's say, backlash. But I will say, from the standpoint of these funds, these asset managers, these funds, especially in the receivables finance space, that are using third-party risk mitigants and are backed by rating agencies. I think this model is going to get some scrutiny by the regulators. Thank you.
Thanks. Daniel, we are now getting the balance sheets from the corporates coming in. Raiffeisen is going to apply some, well, allow me, it's described not really professional, some COVID filters or pandemic filters on all of this. And I'm not really only relating to problematic issues. This could be even in the steel sector, prices doubled up, tripled up. Also, this maybe needs some filtering. That basically is, again, combined to the question I did to Laurent. We are looking into numbers and they are influenced. Do they need filtering in both directions, to the upper and to the lower side? Is this something your bank is doing, or is this really done on a specific customer by customer case?
Yeah, first of all, I think I need to tune in here to the colleagues who spoke before on the topic. Vinko was putting in place the topic of and corporate. For sure, we're looking into this in included country risk, first of all. You might know that rating models projects to put that in place. I think that's a multi-year exercise, so it's not something that we're gonna change now in a few months. So that's a little bit of a difficulty. What we in RBI introduced here is a stronger quarterly view. So I'm fully with you. 2020 standalone is a difficult exercise, or put it the other way around. If we only waited for the figures, we would have reacted way too slow on developments. And as Gourevich was pointing out, building of the portfolio happened in certain areas. So I think that's one thing. So what we basically have on hand is not only as a sector team setup, but also risk management, underwriting, portfolio management is sector-wise set up in order to really understand the business model of our clients on the one hand, and also the cycle where they're in. I think that's very important. And as a second measure, as I said before, we are really trying to put in place a quarterly review on the individual sectors. So we still believe that the downturn is harsh as we thought in metals and exactly ago, or do we now see a huge turn already, like Laurent was putting in place? And I think that's what we're analyzing. We analyze every corporate in it still in the sector, because we might also say there are very difficult sectors, but there are very strong players in difficult sectors as well. So I think the high art, as somebody was putting, is really detecting the risks and making sure that the underwriting is properly set up on our side.
Thanks. Laurent, in Luxembourg, coming back to the origins of this chat, we spoke that credit is needed for buying and purchasing. What's your feeling on this? Are you feeling that you're going to be fully supported? That maybe your suppliers or your customers are going to be fully supported by the insurance industry or by the banking industry through factoring and keeping afloat the entire system? Do you fear there will be disruptions from a risk analysis point of view, because being it so difficult, as we all heard, but being there differences coming up in evaluation, there could be also maybe a little bit of slowdowns into assessing risk and therefore releasing credit, influencing then maybe your sales or your purchases?
Well, I was on mute, sorry. Yeah, sorry, I hope you can hear me. So indeed, the steel industry, it's an industry which is highly intensively using capital and with a relatively low margin. So we are traditionally very much risk adverse, and that's why we are also a very big customer of credit insurance in general. We are probably amongst the biggest purchaser of credit insurance premiums in the world. So we are working a lot with Coface, but also with all credit insurers on the market on that. And so our capacity to offer credit terms to our vast variety of customers, because if you look around you, you will be finding still in many different components of your life. So that would be, of course, cars, but that would be also everything which is related to infrastructure, to civil works, to construction. So we are flowing a large portion of the global economy. So we have a kind of let's say social responsibility sort of on the rest of the economy, and it all relies at the end of the day also on the capacity to get the credit capacity from the credit insurers. It is why it is also so important that you guys, which is, and also we are also massively also financing our receivables. So that's why the collaboration of all you gentlemen around this table is key also for us to continue to get the suppliers credit, which is such a key element of the resources of the working capital of our buyers, because we all know that suppliers credit is even more important than financial loans or even on equity for many different corporates in the world. So we've seen that in 2020, as I think I already mentioned a bit earlier, that all insurers began to withdraw maybe on a more organized way than in 2008. And we also said that we are currently having quite a strong inflation, at least on commodities nowadays. I think I don't recall who was mentioning the aluminium prices earlier, but the steel prices are also climbing 60% more or less over 6 months. So you can imagine that also demand on credit capacity has been also likewise increased over the last 6 months, which is very difficult to follow for the good reasons that indeed we are not in the best period of time to get all the financials that the credit insurer would need to give additional cover. So we have been facing many challenges in the past, and we will be continuing indeed in the next 6 months or 1 year to get the continuation of our capacity to get the supplier credit, notably at one point when these governmental schemes will be over. I think very soon will be over the public insurance schemes, and the rest of these governmental support, whether it will be economic unemployment or the guaranteed loans, will be also one of the key drivers of the credit insurers to continue for them to continue to give us sufficient credit. So yes, we have been facing challenges throughout 2020, 2021, and that's once again the optimism that you guys will be having in the future of the economy will be still a key driver for us to be also optimist on our capacity to continue to flow the economy.
Thanks, Laurent. It was Peter Bacon who was referring to aluminum. There is one thing, allow me a very brief comment on governments. They are calling them government's parachutes. And they are saying, well, now the government's parachutes are going to decline or going then to disappear. For me, it's a little bit funny. I've never seen somebody that was jumping out of a plane without a parachute and having a soft landing, but that's something else. Peter, the last specific question to you, and then we will have a very fast round with the last question. In my impression, the way a company, a fund like yours is handling a little bit its business is a very nice road model for how things need to be seen. A very deep look into the numbers, a very strong outlook and the specifics of how life could be if parameters and financials are going to be cleaned up. And in this way, I'm seeing a little bit your model as, a very nice model that could be a lesson for many out of this pandemic. A very bright overview on how things should be done. Am I wrong? Are you feeling the same? Are you changing or going to change a little bit? Or what's your take on it?
So I think the honest answer is that you relearn old lessons all the time, and crises make you relearn them quicker and with a greater sharpness. So our experience, as I mentioned earlier, is that the crisis has really sharpened our risk mitigation disciplines. It's reminded us that our downside investment case may in fact not be the worst case, and so you have to provide for things being worse than you expect. And what does that mean? It means, as I've said before, primarily you have to provide for liquidity to be available for your businesses. You can't hope to make long-term value if they die in the short term. And the other thing that recent months have also made us focus on is that when we think about liquidity, you have to be very careful what you mean. Money from the shareholder is just money from the shareholder. That's simple to define. But credit lines are complex. Sometimes they're available and sometimes they're not available due to covenants or other methods. I'll give you a real-time example from recent months. Many of our companies, as we've discussed with other colleagues today, use factoring. The availability of factoring depends on the availability of insured receivables. If we have a time like we've had recently where the price of your inventories goes up before you can inflate your receivables, you may think you have enough liquidity, but in fact you can have a credit squeeze, which becomes quickly a spiral into bad things. So we knew all these lessons before, but I think the recent months have made us focus on them even more sharply so that we can preserve the safety of the businesses.
Yes, Peter. We have run a little bit late, so I come to the last question, and maybe let's try to stay in a very short minute in answers, but to get you the last impression. One of the lessons that I guess we all have learned in pandemics, that collaborating and coordinating between parties and on arguments is really one of the best things that can be done. Today, we had something a little bit uncommon. At least I have not seen this happening very often. We had at one table insurances, banks, and corporates. So basically, the three main actors in the economic game. The public, let's leave it a second aside. We had an exchange of impressions. We had an exchange of the past impressions and an exchange on the feelings on the future. For me, it is sounding really to be structurally one of the keys that these actors are talking together, are exchanging maybe in front of a glass of something, also non-alcoholic whatsoever, but are having a chat and exchanging feelings because only coordinating and collaborating between these three parties is assuring us to get the most complete kit of information, of inputs, and develop the best strategies. If I can just ask you to share with us your feelings on it, maybe we start from David Vinco, then we go over to Peter Mulroy, the two Secretary Generals of the associations, and when they go through Laurent Gourevich, Daniel Rath, Peter Bacon, and Laurent Steiner. Maybe, Vinco, you may give us your impressions on today's round chat, not round table.
Well, you touched on a very important point, Freddy, that's collaboration between all stakeholders. And I would like to throw in governments as well. So that makes four. It is banks, credit insurers, corporates as the main drivers of the economy, I have to add, and governments. Now, we need to have collaboration on many levels. From the credit insurance perspective, collaboration needs to be there with, and I mentioned them first, governments. Because governments, this time around, during this crisis, were quick to step in to provide reinsurance to insurance companies to keep the capacity for corporates. If we compare that with the global financial crisis in 2008, 2009, then actually this cooperation where governments helped out credit insurers when the risks turned very difficult. Well, 10 years ago, governments were very slow. Actually, the measures then were put in place when it was no longer needed, and they were too complex. Now, this time around...
The famous operation was successful. Unfortunately, the patient is dead, yes.
Yeah, yes. Now, this time around, especially the European Commission acted very quickly, allowing the European Union member states to reinsure private insurers. Now, that had many benefits. The private insurers could continue insuring their customers. There was no disruption in who provided the insurance. It was still the same insurer, while the governments were taking part of the risk against, I dare say, a disproportional part of the premium. But so be it. That kept trade alive. So we've learned from the previous crisis. Second, cooperation with banks. Now, one of the sectors that was most at risk was SMEs, and especially working capital and liquidity to SMEs. Credit insurers have worked closely with banks to cover banks for their working capital facilities to especially SMEs. New facilities were developed, others were expanded. So that's also a good example of collaboration between insurers and banks. And lastly, cooperation between insurers and corporates. Many of the corporates' customers were in payment distress, and actually that would trigger the credit insurance policy. The insured supplier had to notify the insurer. And if they did not do that on time, they would lose the right to indemnity. Now, together with the insured, insurers have allowed for payment deferral, thus avoiding a claim. That was the benefit for the insurers, but also maintaining the good commercial relationship between the insured supplier and their customers. That relationship was not disrupted by insurers taking over the claim because they had to pay out to their customer. So at all these three fronts, insurer government, insurer banks, insurer corporates, there has been good collaboration. It can still be improved further, but I think we have learned from previous crises.
Thanks. Peter Mulroy. Very, very brief. My guys in Rome handling the connection are signalizing me we are way over time. But a flash of yours. Was it helpful, and was it a proactive chat? Vinko mentioned in Credit 2021 2.0 we are going to add state and public. What's your take? Microphone.
I will say that, yeah, thank you. I will say that to Vinko's very strong point, the collaboration really has been evolutionary, but it's been isolated. Meaning that the success story is the EU. There's no question. We saw also a number, besides the shields, a number of specific receivables programs instituted at the state level, whether they be for purchase order or post shipment. But we didn't see that outside of the EU. For example, in the United States, which has grown in its use of credit insurance as a risk mitigation product, we attempted to get the U.S. Treasury and the Commerce Department and other institutions to look at the shield concept, which, of course, to Vinko's point, they did 10 years ago. So this is the first time the U.S. had let's say, considered it. No, it didn't go anywhere. It was also a very rough period during the Trump administration. Its final months to get them and their departments to look at this in a serious way. But we planted the seeds, and so my hope is that we'll see future progress during the next calamity. The only thing I'll say, the last thing I'll say is, both in terms of traditional receivables finance and let's say a reverse factoring or supply chain finance, we are seeing a big push by governments in the emerging countries, big push really led by the development banks and all over the world, led by at the highest level, the World Bank, IFC, to help incorporate proper assignment laws, incorporate all the necessary legal infrastructure to do receivables purchase programs, whether they be traditional or reverse. And that's going to play a big role in the future, in my opinion, in the emerging countries in the course of the next decade. Thank you.
Thanks. I fully sign up. We are collaborating with these banks, and they are doing at the moment a great job. And there is really a big amount of programs that are starting also based on ESG and others. So really good stuff they are putting on. Laurent in Paris, Laurent Gourevich.
Yeah.
Good. We are fighting this battle together to have discussions and to have collaborations developed and brought up. So, your take?
Yeah, no, I fully agree with what you're saying and what was Peter and Vinko saying. There is no magic in our business, to be honest. There is expertise and analysis. And to run a good analysis and to develop our expertise, we need collaboration and partnership. So our clients are not really clients; they are partners. They are partners, and they are providing us with information, and we need information to run our analysis. So partnership is the key word for us, and this is a lesson from the past. And what Laurent Steiner said about the way we were reacting to the pandemic crisis is the perfect example. We were able to assess in a partnership approach with our clients, where are the risks, where are the credit limits that are unused, where we need to put our effort, etc., etc. So really being close to our partners, meaning corporates, banks, association, reinsurance company, was key to our success. And the relationship with corporate and banks through the brokers, through our other kind of partners, is key for us. So we put a lot of efforts into the services or to the quality of our services to our clients, and this is the only way to survive. So we need, for sure, our clients to provide us with information. We need banks to provide us with financial information. We need them also to provide us with good receivable and their analysis on the sellers. And we need association as well to put a kind of lobbying with governments, with other kind of association, to put all together on the same table and to have the same understanding of what we are doing. And based on that, Coface will be able to support the business for years and for sure.
Thanks. Daniel, I know that I'm running in an open door because Raiffeisen has always offered collaboration and cooperation and was always and is always very good at it. So nothing really new. But anyway, your take.
Yeah, thank you very much. I think for us in Raiffeisen, we are a typical relationship bank, and therefore I think that's within our genes. First of all, collaboration is the one thing, but let me also add here the communications topic. We mentioned a lot of techniques within the last 2 hours, but I think talking to each other is understanding the client, the needs and the issues, then we can react on the risk side, as I mentioned before in statements. Give you one figure of my Vienna team here. We are doing more than 1,000 client meetings per quarter. So there's a very good overview on the different sectors and also on where the status of the client is. So the pure word of talking to each other helps. I think that's one thing. To add in addition, probably, as you said, probably missing here, the governmental part. We, as Raiffeisen Bank International, we are active in 14 countries, and there are a few countries included that are not as easy as they were probably in the past. Russia, we're in the UK, in Belarus. I think it's very important to talk to each other, understand the governments locally, but also understand corporates. I think this is what we are trying to bring together. Collaboration, communication is key for us in this respect.
Thank you very much. Peter Bacon, I hope it was fun. Was it useful?
Relative to my day job, everything is fun. Freddie, thank you. Yes. It was useful. So let me give a couple of remarks. So different colleagues have talked about the role of governments and central banks in keeping the financial system moving through this crisis because of the lessons they learned 10 years ago. However, I think in addition to that, my experience has been that there's a better understanding between the providers of credit and the consumers of corporate credit than there was at the time of the financial crisis. At that time, I had a different job and a different role, which included being on the credit committee of a multinational investment bank, at which time we learned some very painful lessons that we had been much better at assessing how we could distribute risk than understanding the risk which we kept. Now I have a job where I sit on the other side of the table where I'm asking for credit from providers like banks. And my sense now is that banks do a better job of understanding the credit they're providing of the customers that they're dealing with. And as a result, provide, even at times of high leverage, more sustainable and more prudent packages, which are in the end are good for both parties.
Thank you very much, Peter. Laurent, you are the last one, the last one in the row. The final word to you. Again, it's an easy ball. I know that. Let's question again. Was it fun? Was it useful?
Talking about credit is always fun. I agree with what Peter said. So I will try to make it as short as possible because indeed we have been exceeding by far. I just want first to very on a friendly way disagree with what Peter said. It's not a victory of the European Union. All this governmental support has been led by the states. And so this is on the contrary, in my opinion, the return of what we call in France the l'état stratège, the strategic state, and the importance of politics into the economy. And for once, the European Union did not block too much all the national initiatives, and this is something indeed to acknowledge. But everything was led by the different states and quite with sufficient dynamics to avoid us indeed a more severe crisis than the ones we were all forecasting at the beginning. Now, indeed, I will just conclude on the fact that that's true. That as often in the economy, everything is based on the psychology and confidence that the different stakeholders may have in the future. So the confidence that the credit insured may have in the corporates will drive also the bank's credit capacity in the future, and this credit capacity will be also allowing us also to get sufficient confidence in the capacity of our buyers to pay their debts. So I hope that we will be staying going forward in this virtuous cycle and economy for the years to come, and in order to leave us to brightest future as possible. Thank you, Alfred.
Thanks, Laurent. Gentlemen, we were running a little bit late, but I have the feeling that if we would have had another hour, so it wouldn't have been difficult to continue and find arguments to continue this chat. Our job in my company is to promote the dialogue about risk between the stakeholders that are involved. This in order to have the lessest risks possible with the maximum dynamics of liquidity and supply chain. I think today was a terrific exercise to seeing this in action with opinions that has been shared and has been exchanged. I agree that maybe in a credit 2021 or credit 2022 or 2.0 whatsoever, we may invite also the public, because the public part, the states part, because they are the fourth leg of the table, and they would be a good contribution. Anyway, you're going to see, for the attendees who are still with us, you are going to be able to see the replay of this on our YouTube channel. We are going to send to you the link. And we would be very, very welcome. You have the email addresses here on the screen. If you could get to us your inputs and your comments on what you have heard. We are going also to send in the next few days information packages from the participants. And obviously, we will remain available to your inputs, to your ideas. This is a table, and at the table, we are going to discuss and maybe a little bit to design. From London, Vinko David, it was a pleasure. Thank you very much for being here with us. Thank you, Vinko. It was really good having you. Peter Mulroy, theoretically in Amsterdam, but practically somewhere else. I will not disclose it due to NDAs we have signed. Thank you very much for having been with us, and also thank you because this idea was first shared with you, and it was terrific how you supported it. So thanks again, Peter.
Thank you, Freddie.
From Luxembourg, thanks. From Luxembourg, Laurent Steiner. Great as always. It was a pleasure to understand your inputs and your visions. As one of the most important corporates in your field, this was a terrific addition. Thanks a lot.
Vielmals merci.
Peter Bacon, it was a pleasure. You gave us an insight not only in the world of corporates, but also in the world of investment funds, of the world of investors, and of boosters of the economy. And this was really helpful. And I did the question at the end if your take on how to address things is really very close to be a model. It was a serious question. I see it in this way. It was a pleasure having you. Thanks a lot.
Thank you very much.
Laurent, always a pleasure in Paris. I hope you're going to continue to battle together to get corporates, insurances, and banks lined up in the world of sharing good risk and doing a good job. It was terrific having you on board. Thanks.
I'm with you.
Daniel Rath in Vienna. Thanks a lot, Daniel. It was really great to have you. It was a pleasure. I was very, very happy when you immediately gave the okay of being with us. You gave us your views and inputs, and they were extremely of help. I was knowing you, so for me it was not you, but it was terrific to have your inputs on all the arguments. Thanks a lot.
Thank you very much.
Fine. To all the attendees, it was a pleasure. We went a little bit late. Thank you very much for sharing this. And as I said, we would be keen to get your inputs. Thanks, and up to the next one. Thank you. Bye-bye.